Okay, okay. Okay. So good afternoon. We'll get started. Okay. So what you see. Okay. Okay. So what you see is basically we are doing concurrent right now. So of course we are having a physical event, and then at the same time they are handling the online participants lah. Okay. So today's topic will be a little bit into market correlation. So I'll be sharing with you not only just in terms of audio. Yeah, so I'll be sharing with you how you can use this to not only apply into your FX trading, but if today you're also managing, let's say, an investment portfolio in terms of stocks, right? You can actually understand a little bit about correlation, how you can manage it as well, yeah. And then at the end of this session, I'll share with you a offer, kind of like a campaign that the particular broker have right now, called Cover Trade Law, and how you can actually utilize this concept of market correlation that will profit from it. Okay, we'll share a little bit about it at the end of the session itself. Okay, so very quickly about okay. Okay, very quickly about myself. So this is just mainly for those of you who perhaps first time here, right? But I see a lot of familiar faces. Yeah, so my name is Kayong. I started trading in 2012. I turned full-time in 2015. And of course, in these years, I've actually explored a lot of different approach strategies to the market. Okay. So one of the biggest lessons I learned from market is losing a total of $20,000. And that's the lesson I learned about risk management. Okay. So every time I share, to me, risk itself is very, very important. How we manage it doesn't matter if you're doing short term, whatever asset you're looking at the end of the day, risk management is the most important aspect. Okay. So one of the things that I truly enjoy is basically sharing what I've learned, what I know about the market. And of course, the market is ever evolving. Okay. And the only way that a trader or investor can really keep up to it is constantly learning. Okay. And one thing that I always say is you need to be very interested in this in order for you to continue to be trading and investing, right? If you're not interested in it, you probably will give up halfway. So that's a little bit about me. Very quick one here. I'll use this. Okay, very, very quick about me is I'm quite active on social media, Facebook, Instagram. Okay, I do share as well. We do some streams on YouTube as well. But of course, if you're also active on social media, just be aware there are many like scams going around, right? I think that's not new, but it's always there, right? We try to bring those fake accounts down and then just a new one pop up. So I just want to highlight that if let's say you kind of see someone or you receive a message, right, asking you how's your trading, asking you or sharing with you there's this new thing coming in and ask you to pay money to them, just be aware it's not me lah. Okay, because I won't reach out to you privately and then ask you to transfer money. So just be aware, right? It's always going to be there. It has been happening, I think, for like almost 2 years. We reported a few account went down, and then after that, a new one will pop up. Okay. So as I mentioned, today's session we'll talk a little bit about correlation, especially if let's say this is the first time you hear about this concept, you're not familiar with it. We'll introduce to you what exactly this principle of market correlation is. Okay, what are some of the factors that can impact market correlation, right? A lot of times people would have a misunderstanding and say that, oh, market correlation is like cause and effect. Okay, market correlation is not a cause and effect, it's just a phenomenon. So what's the slight difference between cause and effect and phenomenon, right? Cause and effect is like, if today you put your hand under the fire, you're going to hurt yourself, right? So what's the effect of it is you hurt yourself. What's the cause of it is you basically play with fire. Right? It has a direct relationship. It always have one thing leading to another. That's called cause and effect. Yeah, okay. So that's basically what cause and effect means. One thing will always lead to the next. That's called cause and effect. A phenomenon is so happens something tends to happen one after another, but it's not always. Okay. So for example, if today you see a cloudy day, then you will say, oh, likely it will rain, right? So that's actually a phenomenon. Every time you see very cloudy, it has a high chance of raining, right? So that linkage is called phenomenon. It's not a cause and effect. Okay. So you need to be clear when we talk about market correlation, it's not cause and effect. Okay, so it's not like if you see this, then this will 100% happen. It's not, huh? Okay. 哎，又断掉了。现在你把到蹲几遍，我就用这个就好了。OK。Okay, so the importance of it and the application of it, I think as traders, that's what matter most. Okay, how you can actually use this as a potential strategy to actually engage the market. And today we'll share a few principles of what we call defensive utilization of it and offensive. And of course, defensive is more of like how you can protect yourself, how you can protect your capital. Offensive is how you can use this principle to actually make more money, right? So of course, depending on your profile as well, depending on your style of trading, if you are more conservative, you use market correlation as a defensive approach. If you're more aggressive, you use it as an offensive approach, right? Okay, and I mentioned we'll cover a little bit about this campaign called Trade Cover Loss, which is actually a current kind of campaign that is run by a particular broker. Okay, how can I actually utilize this to tie in with market correlation, right? So they kind of put together very, very nicely. Okay, so with that said, let's talk a little bit about market correlation over here, right? So what exactly is, as I mentioned, it's a phenomenon, right? So basically what we do is we study what are some of the relationship of different instruments that we have in the market. We have what we call an internal inter-market correlation. And then we have that, sorry, internal means intra, and then we have the external, which is inter-market, right? Intra-market is basically if today you look at FX itself, currency world, right? So what's the relationship within the different currency within the currency world? And then you have what we call inter-market, okay? Basically FX maybe versus commodities, right? Or let's say you talk about equities versus bonds, right? So those are inter-market because they are out of their individual sphere, right? So market correlation can happen in both, right? You have the intra and then you have the inter, okay? So we're basically looking at a measurement statistically, right? So again, it's not 100%. Sometimes the market correlation phenomenon might break, but most of the time, if they have certain relationship together, that's where you can utilize this principle, okay? So just some very common terminology. Positive correlation means when one go up, the other would likely follow. And then of course, the opposite is negative correlation, right? If one go up, likely the other one will drop, okay? So anything that has, you know, about 70% kind of like relationship, we will call it market correlation. Okay, but of course, sometimes things can be quite random. Okay, like for example, this one goes up, it so happens this also go up, but it's not frequent enough. It maybe only happens like once in a long time, then that's not market correlation, right? That's just so happen it is, right? So you need to understand when we're talking about this, we need to have some kind of statistical measurement, which is for us, 70% and above, if there's some kind of relationship that happens, that's where we can take it into account as market correlated. Okay, I'll give you some example of positive correlation over here. Okay, so first one here is basically stock market. Now if you actually join some of my analysis, you know, I like to just cover S&P, but I often say this, right? Now it doesn't matter whether you're looking at S&P, NASDAQ, or Dow Jones. Basically, if S&P tells you that generally the direction is up, there's a very, very good chance, you know, US market will follow suit, right? Because that's basically correlated, right? Positive correlation. Okay. So what you're looking at here is basically in the US market, we have three indices. They are positively correlated, right? When one go up, the rest would likely follow through. Then we have the commodities as well. Okay. Of course, in terms of commodities, you have soft commodity, hard commodity. This example here is basically energy sector, right? So if crude oil goes up, naturally, natural gas will also go up. Okay, but of course, it's not 100% of the time, but there's that relationship. Okay, and of course, if you are familiar with stocks, right, technology sector, basically they are one conglomerate, right? Apple goes up, Microsoft will likely go up, Amazon will likely go up. Okay, so these are some examples of correlation, and of course, in terms of FX, we do have that as well, right? So euro and franc, they are quite closely correlated. Aussie and New Zealand and CAD and oil. Okay. Now this one here, they are all intra-market, but CAD and oil is an example of what we call inter, right? Because it's beyond just FX, but we are looking at currencies and commodities relationship, right? So there's something you need to be aware of, right? So what are some examples of negative correlation? I think this one quite straightforward. Okay, stocks and bonds, right? You probably heard about this principle before. When stocks goes up, bond price will drop, and then vice versa. But again, this correlation is not very strong. Okay, you will realize that last year or so, the relationship actually breaks up a little bit. Okay, so it's not all the time it's going to happen. So when you are trading, when you're using some of this positive and negative correlation, you can't just use it forever. You need to also understand sometimes you'll break off, how you're going to manage it. Okay, but this is a very, very conventional relationship, right? People will say when you build up your portfolio, you need to have certain assets in stocks, certain assets in bonds, because when one goes down, the other will go up, right? So that's the negative correlation. Okay, and of course you have gold and dollar, right? This one here is the most common misunderstanding that many traders will have, right? They will say, oh, if dollar drops, you buy gold, right? Or if gold goes up, you sell the dollar. I have heard it a lot of times, and I always want to stress, it's not a cause and effect. It's not like dollar drops and gold will rally. No, okay? It so happens when dollar drops, gold tends to rally because you are looking at gold against dollar. Okay, if you look at gold against other instruments like maybe gold against MYR, the whole relationship may not be with the dollar. Yeah, so I want you to be very clear whenever you use market correlation. Be specific, right? It's not cause and effect; it's a phenomenon, right? So this one is one, right? And then we have equities versus VIX. VIX is volatility index, right? It's again a measurement of fear, a measurement of sentiment in the market. Okay, so most of the time when volatility index spike up, it means that we're in a risk-off environment. Things are uncertain. Equities market tends to perform worse off, right? So usually volatility spike, then this one will drop. Okay, so those are basically negative correlation, yeah. Within FX itself, we also have it, right? Basically what we call safe haven and riskier asset, right? So you have like dollar versus the franc, dollar versus the yen, and then you have Aussie versus the yen, New Zealand versus the franc, etc. Okay, we'll dive a little bit deeper into it in terms of the application in a while, right? But this is just an introduction so that you understand what positive and negative correlation is. Okay, so what are some of the things that can impact this, right? Why would it have this phenomenon happening in the market? Right? So there are a couple of things that you need to understand, right? So in total, there are 7 factors. Naturally, we have the macro aspect of things, right? How a certain economy is doing will naturally have an impact in correlation. Market sentiment. Market sentiment refers to the fear and greed of the market. Okay, are we having a very stable, very certain environment, or is the general market uncertain, right? Uncertain means things are unclear. There are a lot of fear. People are not sure about what's going to happen in the future. They tend to be a little bit risk off. Okay, they want to be safer, whereas the opposite is risk on, which means things are good. I can predict the future quite accurately, and then I'm very comfortable in taking a higher risk. Okay, so that's market sentiment. Geopolitical events can affect co-relationship as well, right? Sometimes it can break out co-relationship because of geopolitical events, right? Imagine that time when Brexit was like the top of the news, right? So Euro and GBP suddenly would have some kind of disengagement in the correlation because of Brexit. Okay, so these are examples of geopolitical events, right? Sector and industry trends will impact as well. I think the latest one you'll probably be very familiar with is AI, right? Everyone's talking about it. So AI suddenly becomes an industrial trend, and that builds a very strong co-relationship, right? Anything that has AI related to it would see a positive impact, right? Sometimes you might even be surprised, right? Like some website domain that maybe even has the artificial intelligence keyword or AI keyword, they tend to benefit, but the company does nothing about AI. So things like that can impact the market, okay? Monetary policy, obviously, right? But this one, of course, is linked, right? Macroeconomics will impact monetary policy. Monetary policies will impact macroeconomics. But monetary policy, we are more specific, right? In terms of like, if you're looking at FX, then that will be the fundamental aspect of it, right? Is the central bank hiking rates or is the central bank cutting rates, okay? And last one is seasonal, sorry, that's a 6, right? Seasonal effects. Seasonal effects here, I'm not sure how many of you actually studied seasonal analysis. It's not so particular in FX, but if you're looking at US stocks, seasonal analysis is very, very strong, okay? The reason is because in a year, there are certain months that certain stocks tend to perform a little bit better. Okay. For example, right now in Malaysia, we don't really have 4 seasons, but in the overseas, we have 4 seasons, right? We have spring, summer, autumn, winter. And during winter months, they use more energy because they need to heat up. Okay. In spring, it's not so cold. They don't need to use so much energy. So during winter period, when there's a demand for energy, certain stocks tends to perform better simply because there's a spike in demand. The revenue of that particular company will actually gain more, right? So that's what seasonal analysis really means. Okay. So in the stock market, this is very, very prominent. Okay. And then last one is basically cross-asset interaction. Okay, so this is basically, you know, as I mentioned, inter-market. Okay, how FX will affect maybe, you know, stocks, how stocks can affect bonds, and etc. Okay, so I'll dive a little bit into each of this to give you more example. Okay, macroeconomics, I think quite straightforward, is basically studying how well the country is performing, right? So macroeconomics will have an impact on certain stocks. Okay. So if you, let's say in Malaysia, one of the most common commodities that a lot of people trade is oil. So that itself, right, will relate to that as well, because if today we export more, right, our economic performance is better, then that particular stock, that particular commodity will do a little bit more better, right? If it's the opposite, then it's the otherwise. So another element of it, just I mentioned, macroeconomics ties to monetary policy. So if today an economy is doing very well, likely there's inflationary pressure, then the banks will need to do something, right? And that will also have an impact in it. Okay. So this itself would directly translate to how well a certain asset will perform. So in terms of macroeconomics, it's actually more directly related to stock market. Okay, because when interest rates are rising, when economy is doing well, it will have a direct impact in how well the equities market are doing. Okay. So rising rates are actually not good for equities, okay? But a cutting rates process is actually good for equities. The reason is quite straightforward, because if today interest rates are going up, the cost of money is a bit more expensive. People will borrow less, they will invest less. If today the money is very, very cheap, right? Basically zero interest rate means you can actually borrow money very freely. Then the money that you borrow, you actually spend it, right? You put it somewhere else, and therefore you actually have money invested into equities. Okay, so that's the relationship, yeah. Right. But of course, it has some positive correlationship as well. If today I increase interest rate and then another bank decrease interest rate, it will actually attract investors to pump money into this particular savings or particular fixed D, right? So this will also drive demand. Give you an example, right? If today BOJ, which is the yen, is still very, very low in interest rate, and then let's say US Fed is very high interest rate, okay? So as a Japanese, you'll be thinking, if I put my money in my Japanese bank, I will get nothing, almost zero, right? But if today I convert my yen and I put it in the dollar in US, if I have a US bank, I actually get more interest out of it. So that would drive demand for USD, right? So this decision itself would have an impact in certain currencies. So that's the correlation. Okay, how economic performance, how central bank decisions can impact certain assets, right? And then the next one is market sentiment. So just now I talk a little bit about like risk on, risk off, you know, risk appetite over here. Basically, we're studying how well the market is feeling. Oh yeah, yeah. Take photo quickly, yeah. Yep, this one. Yeah, I think this. Okay. All right. So basically, we have this keyword risk on, risk off. Okay, risk on basically means we are willing to take risks. Risk off means I'm not willing to take risks. Okay, so just imagine like it's a button, it's an on and off switch. Okay. The most direct application of risk on, risk off is naturally if today I'm looking at stocks. Risk on means I invest more in stocks. Risk off means I pull my money out of stock. Right. If today I'm looking at FX, FX also will be impacted by risk on, risk off, right? So we have like risk currencies like Aussie, New Zealand, and then we have safe haven currencies like JPY, dollar, and Swiss franc. Okay, so risk appetite will affect the market as well in general. Okay, so that's how market sentiment can affect market correlation. Yeah, so I think this one, if you are familiar with some of this terminology like risk on, risk off, you've been applying it in FX trading. I think not foreign, quite easy quite easy and straightforward to understand. Yeah. And then we have global events. So global events over here is, not specifically in terms of how well the economy is happening, right? But global events here, we are talking about maybe potential trade war, potential physical war, or even maybe natural disaster that's very, very big and important, right? So any of all those events may also break up market correlation. Okay. Of course, we're not talking about small events, we're talking about really global scale, right? So like, for example, trade tension, right? There was once between US and China. I mean, they've always been doing that, but there was a peak period where it becomes really, really hot, okay? And then, of course, we also talk about the recent ones, Russia and Ukraine, but now not so active anymore, right? But the war is still ongoing. It's just that the media don't really report much about it, and then we think that it's not there, right? But the war is still basically there. And all these are global events that will have certain relationship to financial markets, right? Okay, so just basically understand that it can create what we call a negative correlation. At the same time, it can also create positive correlation, right? So like war would naturally have a positive correlation with wicks because the market is uncertain. It will spike up, and then that will also relate and kind of flood it down to like equities market will then drop, and then gold market will rally, right? Then risk safe haven, risk of asset will also rally, right? So in the financial market, you realize that it's not a binary thing, right? So if I were to kind of give you an idea what I mean by binary, binary in a kind of coding environment is basically 1 and 0. Okay, that's what I mean by binary. If not 1, then it's 0, right? So in a computer world, it's always coding 1 and 0, 1 and 0. It's binary. It's like if it's 1, it's 1. If it's 0, it's 0. Okay, there's no like gray area one. Okay, but in the world of finance, it's not like that. In the world of finance, it's basically there are a lot of factors that can impact it at a single time. Okay, what we want to understand is like at the same time, while let's say there are so many factors impacting the financial world, what is the most important one? Maybe there are 2 out of all. Okay, that's very, very prominent that time. We will all focus on that. Okay, can follow me? Yeah. So this also naturally flow into this thing called money flow. Okay, because it's not binary, there are so many factors that's affecting it. Okay, money will always flow from one to another or from the other to another. Okay, so think of it as, let's say today, you have okay, I simplify it. Let's say today you have 5 wallets, okay, or 5 different assets. Okay, so what you will do is, if today this wallet is safer, this wallet can give you more profit, what will happen naturally is that you will actually maybe convert or transfer, right, some money into that. Okay, it's not going to everything go there, but then some money will go over, right? And then when times change and maybe this one is no longer that popular, right, then what will happen is maybe this one is now more popular and this one is more popular, then the money will start to flow back up. Okay, so this one will come here, this one will go there, this one will come here, something like that, right? So this entire concept is called money flow. Okay, so you need to understand at every point in time when we talk about market correlation, essentially we are also studying where is the money going, that relationship between the assets. And follow, okay. Okay. 听这个 yeah 可以啊。OK 应该是在这里。Yeah. Okay. So that's what I meant by global events. Okay, so next up is sector industry. This is just now what I mentioned, right? If there's an AI trend, okay, anything that relates to AI tends to have certain correlation, right? So this one here is where a specific industry, if it tends to perform better, generally whether a company is very involved in it or the company has slight involvement in it, it tends to benefit overall from it, right? So that's the correlationship that you need to also understand. Okay. Now, these are important because imagine today we talk about AI, okay, and then I give you a company called NVIDIA. You know NVIDIA, right? So NVIDIA actually produces chips. They develop chips that will have a direct impact with AI, because if AI trend grows, the demand for chips is going to be dead. Okay, Then let's say we talk about, I'll give you another one, maybe I don't know, Apple. Okay, do you think Apple is as involved in AI as compared to maybe NVIDIA? You will agree Apple itself would benefit from AI, right? Because it's a tech company. But its involvement, would it be as involved as NVIDIA, for example? More or less? Less, right? Less involvement, right? But would Apple be impacted by this? Yes. Okay. So if today you understand correlationship, right, you realize that Apple will also rally. But if today you want to pick one, NVIDIA and Apple, just for AI trend, which one will you pick? NVIDIA, right? So that's the understanding of market correlation. Okay. Sometimes we use this knowledge to actually filter and cherry pick also. Okay, so all these are applications. We'll dive a little bit into detail as we progress, right? But I'm just giving you some examples as we move on. Huh? So yeah, so this is what I mentioned, right? Recent, we have AI trends. And you know, AI trend is really scary. It started off with ChatGPT, chat version, text version, and then it becomes then it starts to evolve into image version. You all got follow the trend. And then now it becomes video version. And even audio. I saw like YouTube, right? There's one person who actually managed to change his voice to whoever he wants. So you can change your voice to maybe Morgan Freeman. You can change your voice to Obama, right? So it's very, very scary. And you can see how AI would probably have the impact, right, in the market. Okay. Yeah, so that's one. Then another one here is monetary policy, which basically quite closely correlated to macroeconomics. Okay, so central bank decision, which is very relevant to us today, okay, because the Fed is essentially increasing, probably ending already soon, but you can see how that impacts the market. Okay, the dollar has strengthened quite a bit last year, and then right now this year is dropping. Okay? So when you talk about all these events, all these factors that affects market correlation, you understand it's not like all happening at the same time. Okay, the market has this thing called the price-in effect, which we are forward-looking. Okay, so when you're applying all these principles, all these concepts into your trading and investing, right, you need to be a little bit like 1 or 2 steps ahead of what's happening. Okay, you cannot say, oh, the news reported this, and then I make this decision. That is too late. Okay, you need to. This is the news right now. This is what's happening. What will happen next? Your decision is what will happen next. You make a decision based on that. Okay, but of course, in order for you to make a decision on what will happen next, you need to know what's currently happening. Yeah. So that's what you need to be aware of, because you'll be asking, hey, how come the dollar weakened so much when the bank is hiking rates? Okay. Because we are not interested in the hiking rates anymore. We're now interested in when is it going to cut. Okay. That's the conversation that we're having right now, especially to Fed now. Right? So this is something to note. But the relationship is actually quite straightforward, right? The idea is when the Fed increases rates, in the currency world, generally the dollar would strengthen, which is what happened last year. Okay, when it starts to cut rates and go the opposite direction, the currency's valuation will drop. Okay, but as I mentioned, you can't see it from a perspective like, now it's hiking and therefore it's going to go up. No, it went up at the early stage because that's what people are pricing in. They're already putting in the expectation that the Fed will hike rate, right? And it did. And then right now we are pricing in the expectation that the Fed will stop and cut. Okay, and that's why the dollar is weakening. Yeah. Okay, so that relationship is not, as I mentioned, what I want to portray is you cannot read what the news is telling you and then make a decision just based on that. Okay. You need to understand the relationship and then do a little bit of what we call forward looking. Okay, because you know the relationship, you can predict in the future, if let's say it's going to cut, this is what's going to happen. You make your decision based on that. Okay, so yes, and another principle that this 2 years, I mean this year and going forward into next year, that's very, very important for all FX traders is basically what we call fundamental divergence. Okay. Now, what's fundamental divergence is when 2 countries' monetary policy starts to deviate, right? When all major banks do the same thing, then you won't see much effect because everyone is basically hiking, then all their value would continue to go up, right? But when one is hiking and one is cutting, That's what we call divergence. You're going to see a very obvious trend. Now, obviously, the Fed here, we're not looking at it increasing anymore in terms of long term. We are talking about maybe one more hike, or maybe even it's not going to hike anymore with the recent data. And we are talking about how Fed would likely cut rates, maybe end of this year or even next year. Okay. And then if you are following some of the news with related to Bank of Japan, you probably would have read that Bank of Japan is considered hiking rates. Okay. So when everyone has finished hiking and they're thinking of cutting, and then here you are thinking of hiking, that's what we call policy divergence. Okay, so you will get a very clear and nice trend in the FX book. Okay, so this is what we can look to capitalize on in terms of market correlation concept as well. Okay, so I give you an example, right? If let's say RBA is hawkish, which means they are hiking rates, and then RBNZ turns bullish, which means they are considering cutting rates, you get a very nice trend in the pair on Aussie New Zealand. Yeah, so that's the application aspect of things as well. Okay, seasonal trends. Just now we talked a little bit about it, right? So winter period, energy demand will go up. Naturally, stocks that is within this will also benefit from it. Okay, so the most direct, of course, is energy goes up. Commodity prices will go up, right? Then, of course, if you understand the relationship, when commodity prices goes up, certain stocks will go up. Certain currencies like oil price goes up, certain currencies like CAD will also benefit from it. Okay, so in terms of commodities to FX, there's that relationship, right? Commodities to stocks, there's also that relationship. Yeah, and then last one here is basically cross asset. Cross asset is basically a bit warmer. Okay, cross asset is basically about inter-market correlation. Yeah, so this one here, I think we mentioned a little bit about it, right? Like how stock market has related to commodities, and how commodities have related to certain stocks and then certain currencies, etc. Okay, so those are some of the factors you need to understand. Yeah, okay, those are some factors that you need to understand. Okay. Yeah, so I think this is what we call general knowledge. For you to apply this principle, you need to first understand, okay, what can actually impact the market? What has factors that can affect the financial world? Okay, and then within this, we break it down into like how each of these different asset classes have certain relationship, how we can actually maximize and capitalize on those opportunities. Yeah, okay. So the way to understand this is to first kind of break it down into what are some of the general asset classes that we have in the financial world. Okay, so obviously one of the most popular one is always stocks. Okay, we have like equities and stocks, the same thing. Indices, they're all in stocks, right? Then we have the bond market. Bond market here, if you go into deeper details, of course, you have like government bonds, you have corporate bonds, you have junk bonds, etc. Right? So those are all bond markets, right? And then we have a commodity market. Okay, so commodity market again split into like soft and hard, right? Agriculture is also commodity, oil is also commodity, precious metal is also commodity, right? And then we have what we call the money market. Okay, or in short, you can call it FX currencies. They're all your money market. Okay, anything that has cash related to it is also money market, FX currencies, right? So the money in your savings are basically in this market. Okay, and then we have let me see. Okay, one of it is crypto. Somehow I feel I missed something. Okay, should be correct. One of it is crypto, now, which is quite new and relative, right? So the idea is when we talk about money flow, right? Why you need to, of course, have some what we call hypothesis. Okay, and the hypothesis of this is money globally in the entire world is finite, but can increase. Okay, so what I mean by that, finite means it's not something that is unlimited. Okay, but at the same time, it can increase its finite number if you follow that thought process, right? Okay, so who can actually increase the finite number is basically your central bank. When they print money, they increases the fixed amount that's floating out there. Okay. So if you go a little bit into the details, of course, you have this thing called credit and debit, right? But of course, today we don't want to go too deep into that. Okay. So credit debit basically means today you can create money out of thin air. Okay. What I mean by that is, today I say I borrow you 10 million. In your mind, you start to think, well, I already have 10 million. But physically, you may not have 10 million in cash. Then what you can do is can take this 10 million that you have and go and spend. Okay, but how? Swipe credit card. Okay, so that's what creation of credit. You don't have the money, but you realize you have the power of spending that already. Okay, so in the world of finance today, a lot of money is floating in credit terms. Okay, not in cash terms, in credit. So what can create this finite amount is basically banks and credit. Okay, so what I mean by you need to understand this hypothesis is because when you talk about money flow, imagine today, right? We keep numbers very simple, okay? Let's say we only have, okay, I'll put it as 100 units, which means this finite number as of today is 100 units, okay? So everyone in the world entirely add up, the money is 100 units. Everything, okay? And I keep the number easy, okay? Let's just say 100. So everything, credit, cash, everything. Basically, when you talk about money, this is how much the world has. So the understanding of money flow is based on this hypothesis that until the banks decide to print more, this is all we have. And everyone takes a small portion of it. Understand this and visualize it, huh? So money flow is basically, now that we have this amount, where is this amount being allocated? Can follow? Okay. So you need to base on a hypothesis that is finite. That's why we have money flow, because it's finite, and therefore when certain things are performing better, you're going to put your money and take out from somewhere and put your money there. Can follow this thought process? Yeah. So now let's just say in today's context, right? We are seeing equity starting to go higher. Okay. We are seeing that maybe certain currencies are doing very nice. Okay. Maybe crypto is also showing sign of potentially going up. So naturally, where would you want to put your money more? You probably won't take 100 units and you just put 1, 2, 3, right? You still have some here. But money will eventually wants to go here, here, and here. Now, let's say by default, you start off with this is 5. So by default, you start with like 20, 20, 20, 20. Okay. What will happen is this one here, maybe you take out 10, this one you take out 10. So this left 10, this left 10. And then maybe your 20, you split up. Okay. Just roughly, let's say this one here goes 30. And this one here, 25, 25. Can follow? Okay. So the money started to flow, right? From where? From commodities, it flows out. From bond, it flows out, and it goes into stocks, it goes into money market, it goes into crypto market. So when that happened, prices of bond and commodities will naturally drop because people are getting out of the market. There's less demand. Then prices of the stocks will go up simply because money is going in. This one here as well, this one is here. Okay. So that's what the study of money flow is. Okay. Based on the hypothesis that money is finite until being increased. And money tends to go to where it's more attractive and exit where it's least attractive. Now, how do we track exactly how much money is here, here, here? Obviously, we can't. Okay. But understanding market correlation will give you an understanding of where the money will go. Okay. So I give you an example. Okay, building onto this, yeah. I just use one simple market correlation and we talk about interest rate. Okay, so based on just now what we cover, if interest rate goes up, we just talk about one market first, equities. Okay, if interest rate goes up, equities would likely go up or down. Down. Okay, that's the correlationship. Okay, so if interest rate goes down, equities would likely what, right? So that's again a study of correlationship. So how then do we track money flow? Is we track this. Right now, suppose right now the Fed, right? We just talked about the biggest central bank right now. Going forward into 2024, you need to then make an anticipation based on whatever analysis method you have. Do you think the interest rate would likely keep going up or eventually come down? It's a cycle. It will come down. Okay, it will come down. This is 100% will come down. The only thing is when. Time we don't know. Okay, 100% will come down. We don't know when. Okay, so what this means is that eventually, if this starts happening, then you know, oh, there's a correlationship where equities will likely boom. Okay, so that's where the application starts to kick in. So today, if you're interested in, let's say, investing in the long run, this one is naturally what we call a buy and invest. Okay, so why? Because again, understanding from money flow to correlationship, understanding that in the future, what will likely happen, this would likely happen, no, this action would likely happen, and therefore this relationship will kick off, and then we can take action from it. Can follow, right? Yeah, so this is basically one example from this. Okay, but it's so dynamic because if today equities will boom because money is going in, then you also need to go and you can further study like where the money will come from. Is it going to come from cash? Is it going to come from a crypto market? Is it going to come from bond? Is it going to come from commodities? It needs to come from somewhere because of this hypothesis of finite money. Yeah, of course, given that this one is not happening, but of course, at the same time, it's dynamic because the Fed would likely also print money. But as it prints, it's still riding on the principle that it's finite. Because today, if you want to earn 1 ringgit, it needs to come from somewhere, right? It needs to come from someone. Someone needs to be willing to part that 1 ringgit and then you pocket the extra 1 ringgit. So it's finite. Yeah. So you might heard of this term of like, it's a zero-sum game. Technically, it is a zero-sum game, right? Basically means you want to make money, someone needs to lose money. Okay, but that's a very negative thought flow, right? To me, it's not lose, like it's that someone is willing to part that money with. Okay, today you go and buy a very expensive drink. Okay, let's say coffee. Okay, you spend 10 ringgit on that coffee. You happily spend, man. Nobody pointing the gun and saying you must buy a 10 ringgit coffee. So you're happily parting that 10 ringgit, and then someone actually benefited from the 10 ringgit, which is the store, right? Company. Okay. So in a world of money flow, you need to be comfortable with this hypothesis that money is finite. Okay. For someone to make money, someone needs to be willing to part that money with. It may not be worse off, okay, because a lot of people say when one person win, the other must lose. It's not lose, it can be a win-win thing because today you are happy with your coffee, right? The person is so happy that you bought the coffee, so both are happy. Yeah, again, it's depending on how you see the world. But for me, I understand that I see it based on that where money is finite. It's increasing, but it's also finite in a way, right? It cannot create out thin air out nothing unless you talk about credit. But credit is also something that is finite. But at the end of the day, you still need to pay off your credit. Okay? So my view of the world is zero-sum game, but zero-sum game has a negative feel to it. So basically, you just need to switch it a little bit and say that it's finite. Today, if I want to make more money, I need to also make sure someone is happy to part that money with. Okay? In other words, you need to make sure that the exchange is fair. The person is willing to part with. We're not talking about scam. Scam is a different thing. Yeah. So that's how I view, right? It's a little bit on how you choose to view it. Yeah, because a lot of times people say trading is zero-sum. It's not only in trading. Like literally today, you want to run a business, someone needs to pay you in order for you to grow as a business. Yeah. Yeah. Right. Yeah. How would I know that other things coming in? Oh, okay. So I won't have a direct answer to that simply because the world is always changing. You need, again, as I say, as a trader and investor, you need to always be on the ball to understand what's the most important factor that generally the public is observing. Okay. This itself is so we'll put it under global macro, which means it's a general impact. Given that there is no war, the US president is fine, There's no civil conflict, there's no huge major geopolitical aspect, this will happen. But let's say suddenly US president got assassinated, civil war happened in the US, right? Then naturally this won't impact the equities. US market will not go up because of that geopolitical factor. Can understand that, right? So I can't give you an answer like how do we know, because it's always changing. You just basically need to keep track really on what's happening on the ball.
Okay, then the example, let's say President US President is assassinated. Why would we affect him?
Oh, okay, so very good. So you come back to another correlation, right? Because of this thing called sentiment. No, it's not only the local part. Sentiment is essentially fear versus certainty, or what we call like, I'm safe and things like that. Okay, so
why is there fear when the next president of this country?
Because it's uncertain. Okay, just don't need to talk about US, let's talk about Malaysia. During that election period, Malaysian market suffer. It's because of uncertainty, right? Even if it's a new government, people are still uncertain. So at that period where things are uncertain, investment won't come into Malaysia. Or I would say yes, but less as compared when things are certain, right? So it's just a market psychology that people tend to just go for things that are safer. Okay, very simple. Today, I give you two choices. One, you sure make money. The other one, you have a chance of making money. You should go for the 100% one, right? But there's no such thing, right? So it's the same because it's a human psychology. It's called sentiment. So naturally, when certain things that is very huge affect the market kind of psychology between fear and certainty, that will also have an impact in the market. Yeah. So I want you to see, like today we share with you that macro, that few factors of market correlationship. Yeah. You don't see them as separated. You see them as, again, I draw it here just now. All right, I draw it here just now. Basically, it's this lah. Okay, is this right? Cool. Okay. Right. Okay. Okay. Good. Yeah. So this cross asset we talk about it. Okay. So let's talk a little bit about application. I mean, just now we went through a little bit of it. Right. So there are generally 6 applications. Okay. So the 6th application is this. Okay. Again, you don't need to use all, right? But I'm just giving you that idea of how this is being applied. First is we have this thing called portfolio diversification. It's actually more towards equity side, right? Investment side. We have risk management approach, which is quite general. Okay, you can of course use this approach for trading. You can use this for long-term investment. We have asset allocation. A little bit of a similar concept here between diversification and allocation. Okay, we have pair trading. This is a little bit more specific to trading. It's a strategy. We'll share a little bit on that. Event driven as well. Okay, this is even more specific, like something happened out of the blue, you can actually capitalize on it. Like as I mentioned, right? Suddenly US president got assassinated, went missing. Okay, this is an event driven opportunity that you can use market correlation to actually profit from. Okay, and then quant itself, we won't have access to lah. Okay, because quantitative as a retail trader, you won't have the technology to actually execute it. Okay. You may have the brains to do it, but if you don't have the technology, you can't execute it as well, right? When I mean technology, we're referring to like your server speed. Okay, all the algorithms running. It's just like crypto mining. Okay, certain countries can do it. Certain countries it's not worth doing, because again of technology. Okay, technology here we're referring not just the computer tech. Okay, technology here we're referring to how you set up, what location, what geographical location you're in. Okay, crypto mining at that time very popular. Usually, if you establish a crypto mine in colder countries, it's worthwhile. Why? Because mining generates a lot of heat. You try to run crypto mining in Malaysia, your electrical bill is more expensive than the crypto that you mine. Okay, so this is what we mean by technology. Okay, so out of this 6, this one we'll probably not talk about it, okay, because it's not very relevant. So just now I mentioned we have defensive and offensive, right? Defensive is more of like as a conservative trader investor, how I use market correlation to help me manage my downside. Okay, offensive is more like I want to take opportunity of this. How can I use this concept to help me make money? Yeah. Okay, so this tree is under defensive. Okay, one more, right? Okay, so diversification of asset allocation is more or less the same concept. So diversification is like, you know, today, if you want to build a stock portfolio, I think you heard of this before, right? You don't want to put all your capitals in stock. You want to maybe have some in stock, some in commodities, some in, let's say, bonds, right? So that's what we call diversification. Okay. Now, diversification can also expand into like within the stock market, are you heavily in tech? Or do you want to diversify into maybe technology, healthcare, utility, etc., right? So that's diversification. Now, how does this concept comes about? It's also from market correlation. Because if today you have 100% of your portfolio into technology stock. So if something happened in the tech sector, your entire portfolio is down. Okay, so that's the relationship, right? So market correlation. Now, risk management here is also a little bit into the principle of hedging, right? Which we'll talk a little bit more into how we turn this into a strategy as well. So hedging here can be, for example, if today I expect the US market to go up, okay? But at the same time, I'm worried that what if it doesn't go up, okay? So obviously you can have a cut loss point, right? But what you can also alternatively do is you can hedge it by understanding negative correlation, right? So just now we give you a very good example. Stocks goes up, generally bonds will go down. So what you can do is you can buy both stocks and bonds, and then you're basically hedged in a way. Okay, it's not a foolproof thing, but it gives you some sense of management. Can follow, right? Yeah. So that's the idea of it. And then of course, it's an allocation. Okay. Then of course, the more offensive approach, which means I want to use this concept to make money. We have the pairs trading technique. Okay. So over here, what we are looking at is we identify maybe 2 or more assets that has similar correlation, positive correlation. Okay, like for example, 2 stocks within the same industry, right? Which is very common. Like if today you look at airline industry, okay, maybe you have okay, tech easier, right? Let's just say Apple and Microsoft. Okay, they may not be exactly the same products or same industry, but Apple and Microsoft, they're always seen together. Okay, then within this 2, let's say you are more inclined, you believe more in Apple. Okay, so what you can do is you can actually buy Apple, sell Microsoft. Why? Because you strongly believe that Apple will do better than Microsoft. So when one goes up, the other will also likely go up, but go up less. So you bought Apple, you make a lot more. You sold Microsoft, you lose, but you don't lose as much. So net, you're actually growing this portfolio, right? So this is what we mean by pairs trading. Now you apply this to FX, similar concept. Okay, so the FX pair has correlation as well. For example, euro dollar, pound dollar has positive correlation. Aussie dollar, New Zealand dollar has positive correlation. You can also use this technique: buy Aussie dollar, sell Kiwi dollar. Okay, if let's say both are going up, you believe that Aussie will go up more than Kiwi, then net you make money out of it. Yeah, this one will go a little bit more into the details and give you some examples as we progress. Okay, so yeah, that's the general gist of this strategy now. Okay, so when one asset rise, the other tends to lag. Okay, again, nothing is going to move exactly in same magnitude, right? So what you can do is you can also long the underperforming asset. Okay, this one here, okay, may not be so straightforward. Okay, but this one, right, basically comes from the concept of a value chain, right? So this is another principle that you guys can understand. Okay, value chain basically, I'll just use example of AI. I think it's a little bit in the trend right now, right? So just now we mentioned this thing called NVIDIA. Okay, you all know what NVIDIA do? Roughly lah. Yeah, correct. Chip, basically it produce chips, right? Okay, specific chips lah for AI related computer technology, etc. Now, where does the raw material of NVIDIA comes from? Okay, not so specific in the country, but it needs to come from somewhere, right? It needs to come from a raw material in order for you to produce chip, because NVIDIA don't go and mine the raw materials. Can you understand that, right? Okay, so let's say it has another company. Okay, for example, company A, yeah? Then let's look down as well, right? After NVIDIA produced the chip, it doesn't just, sell to you the chips. It goes to somewhere else before, it reach the mass market, right? So can you think of one example of where these chips will go? When we talk about AI. Yeah, correct. So maybe, computers related stuff, right? So maybe we talk about like Mac or Microsoft, right? Okay. So we have these two companies. Okay. So these two companies, then after that, let's say, we keep it simple. These two companies eventually will sell to mass market. Okay, which is of course all of us, right? We buy computers and things like that. Okay. So how do you understand value chain, and how do you kind of like utilize that principle of market correlation? These are definitely all correlated. You can see that, right? Because if AI boom, this you would want, demand for this will go up, demand for this will go up, demand for this will go up. And follow? So that's the relationship. Okay. Now, of course, all these are in the stock market. Okay, it's internally, right? So the idea of the strategy here is, which one do you think will boom first? This one? Yeah. Actually, you're right. This will boom first more than this. Why? Because if the value chain, right, everything on top has more power than the bottom. The one producing supply, these two. Okay, they are producing what we call supply. This one here is this is what we call a consumer of this. This is consumer of this. This is consumer of this. You understand, right? So the higher the value chain, the more you have power of control. Why? Because if today Apple don't want to buy from me, I have Microsoft. Okay. If Microsoft don't want to buy from me, maybe he has another company. Okay. But if today you don't want to buy from Apple, Apple probably won't have much to sell left. Can follow? Okay. So the lower you go in terms of value chain, the more reliant you are at the bottom. Okay. So when you understand this, right? I mean, you beyond just market correlation, you can actually use this to actually help you invest as well. Today, if you, let's say you want to invest in AI team, okay, you don't want to throw everything to Apple and Microsoft. You want to maybe allocate, here maybe 30% in your AI portfolio. Maybe this one you put a little bit more, 50%. And then maybe this one, which, to be honest, I won't know much. I didn't go and study much into this. But to me, NVIDIA is more or less at the top, right? So maybe you can even allocate 20% here, for example. Okay. So this is also what we call diversification, understanding correlation. Okay. So there's a lot of application to that. Okay. So the idea is, again, if you see this rally, there's a good chance that this stock will also rally, but it will lag. This will take immediate, like suddenly a news comes out about AI, this will soar, this will go up. But this one here might lag maybe 1 month, 2 months later. Okay. So suppose today you are more of a short-term trader, you start to see NVIDIA goes up with an AI reason, you have a good chance to predict that this will likely go up maybe in the next 1 or 2 months as well. Okay, so as a trader, you can then capitalize on this opportunity too. You can say, okay, NVIDIA rocket up maybe 100%, for example. Then this one here haven't done that yet. Maybe I can look for buy opportunity. Okay, so this is also understanding market correlation, but the concept is it will lag a little bit. Yeah. Good. Yes, yes. So that's the concept. I'm just using AI because it's more relevant nowadays. Yeah. So, okay. So that's the application of pair trading, right? So event trading is basically more or less the same logic. It's just that this one is more specific. Something big happened in a short period of time, you quickly take opportunity of it, right? So for example, COVID, in Malaysia, what is the market correlation flow? When COVID at its peak, what was the flow of correlation that benefited the stock market in Malaysia? Glove lah. So that is also an event-driven market correlation. Okay, because why? It's not cause and effect, but there's a relationship, right? Because there's a demand for that. Suddenly, people think that the revenue of this company will go up, and then therefore we buy, and then it just shoot up. Okay, so this may not happen every other day, okay, but that's where you can actually look into it. Yeah, I mean, some of it, like for example, Ukraine and Russia, when it first happened, when the media is covering it a lot, it's also an event-driven opportunity, right? Because certain commodities will go up, like oil. Okay, because why? Oil requires for war, right? It's one of the very important commodity to win a war. Okay, and then oil itself will have a market correlation with CAC, right? So all this will have impact to it. Okay, so today I'm just going to show you some charts to give you an idea of how we study relationship. Now this is a chart on euro dollar. It's a daily chart. Okay, just generally kind of look at it. It's from this low going up. Okay, so it's an up move, right? In that same period of time, GBP USD is also going up. Okay, so the shape of how it's going up is also quite similar. Okay, so these two currencies is what we call positively correlated. Okay, now if I put two charts together, you can see that, right? Blue is in euro, orange is in pound. Okay, now it's not 100%, right? Because you can see over here there's a slight divergence, right? This one is going up. Okay, more or less, this one is going up, but this one goes sideways. Okay, this one comes down, it matches back, and then everything follows through. But there's a slight divergence in this period. This is going up, this is going sideways. Right? So it's not 100%, it's not foolproof, but the general direction is the same. The magnitude is different. Okay, no two assets will always move in the same magnitude. When I mean magnitude means if euro dollar goes up 10%, pound goes up 10%, that's equal magnitude. It's not going to happen. The general direction is going to be the same, but the magnitude would not be the same. Okay, so you can see this is what we call positive correlation between these two. Then we have Aussie. Okay, so you can see general shape, go up, come down, go sideways. And then on New Zealand dollar, like more or less the same, go up, come down a little bit, go sideways. But the magnitude is different again. Okay, if you can't overlay these two charts together, you see more or less the same. Okay, so this is what we call studying market correlation. Okay, within the FX world itself, right? So how do you use it for defensive? Now, if you understand the relationship, you want to use it for defensive, meaning conservative approach, manage your downside, manage your risk. You don't go and buy Aussie and buy New Zealand at the same time, because when one loses, likely the other one you also lose. Okay, if you're more offensive, of course you can do buy both lah. Okay, then if you make more, right? But later I'll share with you a little bit on a mixture of it, a combination of it, meaning you buy one, you sell the other. But how then do you know which one to buy, right? Which one to sell? We can use a little bit more into the details of that technique. Right? We'll cover that. Oh, no, this is just show you the relationship only. That's it. Yeah. Oh, no, there's no analysis here. It's just the general relationship of the two assets. Yeah. Okay. So yen, there's dollar yen, okay, and dollar franc. It looks a little bit different. Okay, you can see this one yen and franc. Okay, if I map that two together, it usually has a positive correlation until this part. Okay, so again, I want you to understand, it's not something that is going to be forever. There will be a period where it will break off, and then you realize this period onwards, it goes back in sync. Can follow, yeah? Okay, so you need to be aware is when you apply this technique, market correlation into your trading, it's not a foolproof thing. It's not like guarantee you sure win, okay? Because there are periods where this can break off. Imagine you think that it's going to be always there, and then you sell this and you buy this in this period, you lose money. Okay, so I just want you to know there are certain events that can happen and breaks off the market correlation. Okay, but other than that, you can see quite nice, right? Okay, it's only this period of time where it broke off. Okay, if you look at commodities, gold and silver is also there, the relationship, right? So you can see generally going up, and then silver more or less the same shape. Okay, if you put them together, blue line is gold, orange is silver. General shape is the same. The magnitude is very different. Okay, so this one goes up, but you see this one goes up very, very strong. Okay, this one comes down a little bit, but this one comes down very, very fast. This one goes up a little bit, this one goes up a lot. Okay, recently This goes up a little bit, this one goes up a lot. Okay, so magnitude is different. So at some point in time, okay, using all this observation, understanding, right? You also want to put it inside, right, in your strategy. Let's say today I'm interested in gold and silver, right? Which one do you think, if I want to buy, which one would I be buying? The one that probably can make me a little bit more money, right? So I'll be probably saying, okay, if I want to buy, I'll probably buy silver. Maybe if I want to hedge it, I'll sell gold. So I'll buy silver, sell gold, and then at the point where if this happens, that means precious metal goes up, I will lose money in gold because I sold it, but I'll make more money in silver. So net, I'm kind of profitable as well. But I limit the downside. Why? Because if precious metal drop, then I'll make money from gold and then I'll lose money on silver. Hopefully, it's going to be net break even. Okay, so that's the application of it, right? In terms of understanding correlationship. Okay, so how then do we choose, okay, between gold and silver, which one to buy, which one to sell? Or maybe FX pair like euro and pound, they have a positive correlation, which one do we choose? Aussie and New Zealand, which one do we choose? Okay, so we can use this technique called crosses, or what we call ratios. Okay, so again, this you can use it for many different assets. It's not only FX and commodities, you can use it in stocks. So like example, you think that Apple and Microsoft correlated, okay, you can use Apple and Microsoft as a ratio. Okay, what I mean by that is you take a chart on TradingView, you take Apple chart, divide it by Microsoft chart, you get a ratio. Can follow? Okay, I'll give you some example on FX and commodities first. Right, so we can use this ratio to identify which asset tends to perform relatively better or relatively worse off. Okay, so we can use this mainly for hedging or filtering trades. Okay, so if today you want to use it as hedging, you decide which to buy, which to sell. If you use it for filtering, means that you have a general sense of direction already, but you want to decide, do I buy Aussie or buy New Zealand? I'm interested in the buy, but should I buy this or buy the other, right? Then this is where you use it as a filtering. Okay, if you use it as hedging, basically, I want to buy the other one, I'll just sell it. So which one to buy, which one to sell, right? So you choose, right? So over here, how we use it, okay, these are some of the common ratios we can consider. Okay, of course, you realize that they are all having some kind of a positive correlation. These two are positively correlated, same thing here. Gold and silver. SPY is basically your S&P. EEM is basically your developing markets. Okay, so this one is also equities. They are correlated. Okay, so let me show you an example, right? Let's talk about euro pound. Okay, now suppose you look at the chart on euro pound, yeah, and then you do your own technical analysis, and let's say you anticipate that euro pound in the next maybe few days, next few weeks, euro pound will likely go up. Okay, if euro pound is likely going to go up, what this means is that euro will be relatively stronger than pound. Can understand this logic, right? Because euro pound is basically a ratio. If this needs to go up, this has to be stronger than that. Okay, or this can still go up if this is weaker than that. Can you follow me? It does not necessarily mean that euro and pound needs to go up. It can be both coming down, but if pound is weaker than euro, this ratio will still go up. Can you follow me? Okay, so based on this ratio, this pair itself, euro pound, if we understand that this has higher chance of going up, it helps us to give this information. If today I want to buy euro, okay, then no, sorry, again, I repeat that. Okay, if today I'm interested in buying euro and buying pound, okay, EUR USD, GBP USD, these two pairs I'm interested to buy, but I don't want to buy both because I understand they have a positive correlation. I want to manage my downside, I want to manage my risk. So what I can do, I can look at euro pound and use this pair and say, okay, if this is likely going to go up, okay, between euro and pound, which one do you think I would be focusing on buying? Euro dollar, makes sense, right? If today I'm interested to sell euro dollar or pound dollar and I want to choose one, then looking at this chart here, I understand that there's a good chance pound will be weaker. That I'll be focusing on selling pound dollar. I'm following that, right? Now, if I want to hedge, then it becomes very straightforward. This is likely going to go up, and I analyze my euro dollar and pound dollar. Both are telling me there's a good chance of going up. Then I'll buy euro dollar and then I'll sell pound dollar as a form of hedge. In the event my analysis are all wrong, I won't lose a lot because pound will profit, euro will lose, net maybe I'll break even. But if both goes up, there's a good chance euro would rally more than pound. My pound is losing, but my euro is making more. I close up everything, I still make. Yeah, so that's how you can utilize this principle. Okay, so same thing here, right? Just I mentioned all this, right? So basically, if you're thinking of buying basically either of this, you use euro pound, you can actually understand which one has a higher probability. Yeah, good. Okay, so this is basically just now what I explained. Okay, this is in text. Okay, so same principle you can actually apply in Aussie New Zealand. Okay, same thing. This is a ratio. Both are positively correlated. So if you analyze this chart and say, okay, there's a good chance in the future you're likely going to continue going to go down. Okay, then when you are making decisions related to Aussie and New Zealand, this ratio, this crosshair will help you with an additional insight. Okay, so instead of just looking at Aussie dollar chart and New Zealand dollar chart, you don't know which one to choose. You use a crosshair help you to filter off, or even help you to make some hedging decisions. So the reason is quite similar, right? If today you decide to buy either of that, then you know, looking at Aussie New Zealand chart, which one will have a higher probability. Yeah. So all these are FX example. We'll take a look about gold and silver as well. Okay, we call this gold-silver ratio. Okay. Now FX itself, you can of course in your MT4, MT5, most brokers would have euro pound and Aussie New Zealand. But gold-silver ratio, you probably would need to do it in TradingView. Okay, basically you just type in XAU/XAG, you click enter, it will come out with this ratio. Okay, so what it does is mathematically, okay, you are taking gold price on top, silver price at the bottom. Okay, if this ratio goes down, again, it means that gold here would be relatively weaker than this, or this one here is stronger than gold. Okay, so it's a mathematical ratio formula, right? So of course, you also need the prerequisite given is you need to know how to look at technical charts. Okay, if you open up this ratio and you have no idea how to perform your technical analysis, then it's useless. Okay. You need to know, looking at a chart, should I buy or should I sell? Then you use this as additional information to help you make decision on that. Okay. So suppose this one here, gold-silver ratio, we know we are expecting more downside. Okay, then we know, okay, if today I want to buy and invest in commodities, silver might be a better option, right? Because silver has a chance of strengthening more than gold. If today I want to sell commodities, then I know, oh, gold may be a better option to sell than silver. Right? So this can give you the extra information. Okay, so same thing here, right? If you want to buy gold or silver, you're deciding which one. Based on the ratio, silver may be better, right? If you are deciding to sell, then of course gold will be better, or you can use it as a hedge, right? You can buy silver, sell gold. Yeah. So this principle not difficult, right? Cool. So this one here is also an example of equities. Okay, I'm using indices. As I mentioned, you can use individual stocks that has a positive correlation. The most common application in individual stock I've seen a lot is people use it in airline industry. Okay, because why? It's very competitive in the industry. Today, if you want to fly, if you fly in Malaysia, let's say you fly with AirAsia, then you will not fly with MAS, right? In the same trip. On that same trip, if you choose AirAsia, MAS would not have your sales. MAS will not have your business. If today, in the same trip, you choose MAS, then AirAsia will not have your business. So this is a very competitive industry because in that trip, it's either one or another. There's no way you're going to choose both. Okay. So because of that, a lot of traders use airline and use this method to pick which stock for airline industry has a higher chance of performing better. So they buy one, they sell another to hedge it. Okay. So you buy the one that you think it has a higher chance of going up, and then you sell the other one just to hedge it in the event that the entire airline industry drops, you won't lose a lot. Okay, follow that thought process, yeah? Okay, but this one here, we are looking at general market. Okay, we are comparing developed markets versus emerging market. Okay, again, we are using the principle of what? Money flow. Because if today money goes into developed market, it needs to come from somewhere. If money wants to go into developing markets, it needs to come from somewhere. So we're basically just comparing developed versus developing. Okay, so EM is a ETF for developing countries, okay, developing markets. Not just specific country, but it has a basket of it. Okay. Now, suppose this ratio, we analyze that, okay, there's a good chance in the short run, at least this will come down. Okay, so if this ratio were to come down, means developing markets would likely perform better. Okay. So if today you're thinking of, okay, I want to start off investing into equities market, likely you want to put a little bit more money in developing and maybe smaller portion in a developed market, because if this happens, likely you're going to make more money. Okay. So what you can, of course, again, do is same thing, right? I mean, in terms of stocks and investment, we seldom sell. So we are basically just deciding, which one to rebalance, which one to diversify, which one to allocate more of our capital. Okay, because if you're doing investing, you're looking at long term, then maybe, if you're going to start off this portfolio, you put maybe 60%, 70% on emerging, and then maybe the remaining 40, 30% on developed markets. Okay, so this is how you can actually utilize a ratio like that. So far, so good, huh? Okay. Right, so of course you can also use it as a hedge now. Okay. So far, any question? If you use hedge, you naturally earn less. You earn less if you hedge. Okay, why? Because you're buying one, you're selling. Okay, I'll give you an example. Maybe this one, right? Now, suppose you do this, okay? You buy silver, you sell gold, okay? Because these two are positively correlated. Now, suppose the commodity markets rally, so you make money here, but you lose money here, okay? But based on the ratio, there's a good chance you make more here and you lose smaller here, right? So what? Give you a figure, right? Let's say you make $10 here. This one maybe you lose $8. You close everything, you net pocket $2. Okay? But if today you don't hedge, you just buy, then you make $10. But if this drop, you can also lose $10. But if you hedge, maybe this one drop, you make, because you sell, right? Maybe you make $8. This one maybe you drop, you lose $8, net zero. Yeah. So hedging protects the downside, but also may limit your potential upside. Yeah. 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 Correct. So it can happen like that also. So it's not like confirm you make money lah. There's no guarantee lah, right? But the idea is if you don't hedge, you might lose entirely 10 or 8. But if you hedge here, even if this drop 10, this drop 8, net you make 8, you lose 10, net you still lose $2 based on the hedge. So hedging is reducing your volatility of the capital. It's not 100% lose proof lah. But today, I'm going to share with you a campaign that have a limited number of trades that can be lose proof lah. Just a limited number. So I don't know how long this campaign will run, but I can share with you a bit. Okay. Yeah, but this is based on basically understanding market correlation. Okay. So you need to be very, very strong in this concept to kind of like play around with the market. Okay. Good. Before that, any question? Yeah. Equal. You need to be equal, or else it won't be an equal and balanced hedge now. Why do we hedge? Again, is to prevent the downside, mainly is to prevent that. So nobody really hedge to fully maximize your profit, because as I mentioned, if you do this, you cap your profit, but you protect your downside. Because today, while we are thinking that, okay, commodities will go up, but there are certain things that maybe we won't foresee, right? Suddenly, maybe commodities, we can't really say, but let's say equities, stocks, easier, or even currencies, right? Let's say stocks market, we expect it to go up, but then suddenly US decides to declare war with China, physical one, then naturally it will drop. But we won't know, right? We can't say, oh, they're going to announce it next week. We won't know. So what we can do is we can always protect our downside by doing a little bit of a hedge. So that's the primary function of hedging. So you buy because you anticipate it go up, but you always want to have some kind of like an insurance, right? So what you do is you find a positive correlated one, you sell it. So in the event it really collapses, you won't lose so much. You reduce the volatility of your up and down. Yeah, I mean, you can play around with it, but the logic and the principle behind hedging is really to reduce, number one, the volatility, protect your downside. You can also play around with different derivatives. Okay, if you're very familiar with options market, people use options to hedge as well. Okay, so what you do is you buy the underlying asset. For example, today I want to buy NVIDIA. I expect NVIDIA to go up further, but I also worry that what if the AI trend dies? Okay, it becomes a hype and then it dies, right? So I also worry about that. So what I can do is I can buy NVIDIA underlying asset. I buy into the shares, I buy into the stock. But then I look at the options market and I say, okay, I want to sell NVIDIA through options. Okay. So what happens is I can also collect premium now, right? Then at the same time, if let's say NVIDIA really collapse, I'll make back my losing trade on NVIDIA on the options market. Yeah. So you can play around with derivative if you're familiar with it, but it's more complex because you are taking, you need to handle more stuff. Today's example is more of like just telling you straight off in terms of spot market. You buy this, you sell that. Yeah, but you can use this principle, apply into more advanced technique. Yeah. I answer your question. Yeah. All right, do I have okay. So with that, where's my mouse? Oh, okay. Okay. So with that said, right, let me share with you a strategy that you can only use maybe once. Dealer not very happy because this is actually the offer lah. that comes from their broker lah. Okay. And then they have also naturally for some TNC. But I thought of this TNC doesn't cover market correlation. We can use this principle lah. So I don't know whether I can use how long, but maybe next month no more already. after today. Okay, so I share with you this. But of course, this one here is utilizing. So again, I want to show you the practical aspect, okay, of how market correlation can be actually applied into trading. Okay. So just very briefly, later Dylan will share with you more details about that. Okay, but very briefly, they are running a campaign called Cover Trade Loss. Okay, so this campaign basically means that in the first 10 trades that you take, if you have some losses, they can cover it. Yeah, they can cover it. But of course, they are TNC and it's only first 10 trade. So if let's say today you trade, your first 10 trade win, then no more lah, done. Okay, if you trade, your first 10 trade all lose, then yes. Depending on how much you lose, right? So in terms of their TNC, if today you put in 500 deposit, the 10 trades maximum cap is $8 per trade. Okay, so if let's say out of the 10 trade, there's one trade you lose $10, they only rebate you $8. Okay, so if today you put $1,000, then the cap will be $16 per trade. So if that trade you lose $20, they only rebate you $16. Okay. Okay, and these are all within your first 10 trades. After that, no more. Okay, so if you win 10, your 11 trade you lose, no more. Okay. No, total. Yeah. So whatever it is your first 10 trades, right? So based on when they share with me this, I immediately think of market correlation. Okay. So just put that into a little bit of practice. Any one of you have idea of how you can utilize market correlation for this campaign? Give you some practice. Buy and sell? Oh, cannot. So one of their TNC is you cannot buy and sell at the same time for the particular asset. Can also lah, that's if you trust your friend, but that one a bit not related to market correlation already. Is as your individual understanding market correlation principle, how can you utilize it to help you benefit from this campaign? Ah, very good. Okay. Ah, yeah. Okay. So it's as a trader, if you understand market correlation, that's exactly how you can use this principle, right? So you understand that asset in positively correlated environment, both will move in tandem, right? Okay, but of course we won't know for sure 100% whether it's going to go up or go down. Okay, but suppose rough sharing, because you need to do analysis as well, right? Now suppose I'm more interested in major pairs. Okay, so I'll be focusing on euro dollar and let's say pound dollar, right? And then we apply the principle between these two, which one we should buy, which one we should sell. We can look into this pair called euro pound. Understand that, right? So we talk about this, right? So look at euro pound as a ratio. You will then understand, okay, if euro pound generally will go up, that means euro will likely strengthen more than pound. If euro pound generally, your analysis tells you it will come down, then what will happen is euro will be relatively weaker than pound. Okay, so depending on this analysis here, then you will make a decision. Okay, suppose based on analysis, okay, euro pound is likely going to go up. Then what we can do is we can initiate a buy on euro dollar. And then we hedge it using pound dollar. Okay, so if we are right, then this one would likely make us more. Ideally, okay, this will make us more. Maybe this one will make us $10. And then this one, because we sell it and it positively correlated, this one will still go up. But this one maybe will go up less and we can maybe lose $8. And follow? Now, even without this campaign, you will make money lah. Then you make $2. But because of the campaign, this one will be given back to you lah. So it's you make $10 lah. First 10 trade. So when you do this, you only have 5. So you cannot exploit everything lah. And there's a cap. So if you put $500, maximum per trade is $8 lah. Yeah. So this is giving you, I would say, give you this risk-free chance to explore market correlation and risk-free chance to let you explore hedging. Okay, let you explore hedging. So it's not 包价, it's not like confirm win. Okay, because you still need to factor in, a little bit whether to buy or sell, which one buy, which one sell, how you manage your risk, how you manage your lot size. Okay, now if today you go and put in a 1 lot, okay, and 1 bit movement already more than that lah. Okay, then I cannot help you. Okay, so there are still elements in trading that you need to put in. Okay, so it's something not like, as I mentioned, it's not sure win. Okay, but it's something that will give you a risk-free opportunity to go and practice this principle that we cover. So far, can follow, Okay, so yeah, so basically the idea is if you put 500, then it's capped at this. If you put $1,000, then it's capped at that. Okay, and it's just first 10 trade. So if you do this, it's 2 trades at 1. So you can only kind of like apply this and practice 5 times lah. Okay. Yeah. So if you put 2,000, it's still 16 lah. Okay, this is not a loophole. This is it's just a campaign for you. No lah. If the broker give you that, you also worry where the money come from. Okay. So it's not something for you to kind of like exploit everything lah, right? It's, as I mentioned, it's a campaign to let you try out this concept for risk-free or minimum risk. Yeah. Yeah. So ideally, just give you some math, simple, right? Ideally, you put in 500. Let's say you base on that. Okay. So they cover you $8 max per trade. So based on the calculation, it's just 40. 5 trades, so it's 40. Okay. So ideally, you just do 1:1 lah, meaning you lose 40 for 5 trades, they cover you, and then the other trades you basically make 40 lah. Can follow that thought process. So it's just 1:1, right? So basically, when one stop loss, another one you TP lah. Okay. So based on this, your first 10 trade, if you do everything like that, then you'll be almost about 8%, almost guarantee profit. Yeah. So that's the rough estimate. So it's not too bad lah, 8% almost guaranteed. You might make more. I mean, if you are a little bit more experienced, you may close off one losing one, cut it at 8. The one you can let it run, right, and manage it depending again on your experience in the market, right? So this is like giving you a very simple calculation of it. Yeah. Good. Yeah, I think let me go back to the slides. Yeah, so far so good. Okay, so there's T and C, right? So later Dylan will share with you a little bit more. But generally what I share with you is doable. Okay. So this one is the example, right? So basically, you buy one, you hedge the other one, okay, and then you basically have your risk management in place. And then from there, there's a good chance one will win, one will lose. And then using this, you can use the current campaign offer to cover that. Yeah, good. So before I jump on this, any question? T and C later you ask. Okay, but market correlation, any questions online? Don't have, all good. Okay, so without that, then I'll do a closing here first to share with you some of the recent updates, some of the events that we may have. And then after that, Dylan will cover a bit more on the T&C. If you have any questions related to brokerage as well, you can actually, feel free to ask. So first one here is we have this Telegram channel. I think, familiar faces you're already in. Okay, but for those of you who are first time here, you can scan this QR code. It will direct you to a Telegram channel. So inside, I'll be updating some market analysis, and then any events that we have, we also will put it up to inform you guys. Okay. So it's free, right? You can scan a QR code. Now, what we also do on a week-to-week basis every Monday is we run market analysis live. Okay, Monday 9:30 p.m. So it's happening on Zoom. Okay, so same thing here. If you go into if you join the Telegram channel on Monday, they'll post up a link. You just need to click the link and then you'll join into the Zoom call. Yeah, so this is happening every Monday 9:30 p.m. Okay, it takes on average about 30 minutes. Then we are done. Next one, okay, is PAM. Okay, so this is quite recent. Zenfinix recently just launched its PAM feature. So this is actually an EA. EA stands for Expert Advisor, or you might heard of it before, like robot trading, algo trading. What it does is basically we let an EA manage the account, right? Basically, it runs the market, it execute order, it manage the order, it exit the trade. So this EA has been running since 2021. So I use it personally since 2021 in my own account. And in May this year, Zenfinix launched its PAM feature. So I decided to open an account on this to write on the EA for anyone who's interested in. Okay. So again, there's no guarantee as to how well this EA can perform. There's no guarantee that you sure make money. But since 2021 until now, on average month to month, it can easily make about 2 to 3% return per month. Some months are more, some months are less. I just want to show you, June is 1.3, May was 8, July so far, as of Friday, was 6.2. This account here, max drawdown is about 20% so far. Yeah. So there are risks, okay, because we can't guarantee it's definitely going to perform all the way. There's risk, which means as an EA, it uses certain management system called martingale. Okay, martingale in short is about doubling down, right? So if you are not comfortable with that kind of approach, obviously then this will not be for you. Okay, so it's not like you need to join. Okay, there's options out there. So this is something that you can consider if you're keen. Okay, so this account just trades one pair, dollar Canadian. Okay, and only one pair. And how PAM works later, maybe Dylan will also share a little bit if you have questions related to Zenfinix PAM. But in general, how PAM works is we have a master account. Okay, basically that's the account that manages. the EA. And then what happens is investors account, if you're keen, you can actually tag into this PEM. Okay. So tagging means you need to sign a simple LPOA, understand, what's the feature, what are those risks involved, and then you tag the account. And then whenever the trade is taken, automatically it's taken in that master account. And then at the end of the month, what this feature PEM system will do, it will split up profits to all the investors. Okay. So for example, if you make about 6% here, means whatever amount you put in, you're making about more or less 6% minus off a little bit of the performance fee. Okay. Performance fee basically is this account is split 70-30. Okay, meaning as an investor, you get back 70% of the profits that were generated. Right. So if you see this one here, it's about 6%. So you calculate it about 70%. It's about 4.5 something lah. Okay. So yeah, that's a calculation of it. But it's not staking. It's not staking. Okay. So staking is it's like fixed D. You think staking as fixed D. This is not. Okay, staking has lower risk in a way lah, if you choose the right platform. Yeah. So this one, there's a minimum amount because it's an EA. You can't join with just $100. It's very dangerous as an EA. So this one here, you need to prepare at least about $1,000 US before you can actually join in. Okay. So the thing is, if today you feel that $1,000 is a bit too much, too high, then we'll suggest is build up your capital base first before joining. Because if you join too small, it's risky because you don't have enough capital for it to actually manage it. Yes, as a PEM, that's how it generally works. So you open your own account, okay, you put in your deposit, and then you sign an LPOA to tag this account to the master account. Yeah. Expert advisor. Yeah, robot. So EA stands for expert advisor. Other names people give is like algo trading, robot trading. PEM is percentage allocation management module. It's not copy. It's basically okay. I draw a little bit so you understand. Okay, so how it works are like this, right? So we have a master account, okay, and then let's say they are for simple illustration, right? We have, let's say, A, B, C, D investor, okay, and let's say out of this, this one put 1,000, this one put 1,000, this one 1,000, and then this one 2,000. Okay, so what will happen is it's not copy trade, but the funds will be tagged into a master account. Okay, so 1, 1, and 2, so that becomes a master account here is 5K. Okay, so what will happen is I will be looking at this account only. I won't be looking at so many other investors. I'll be looking at this account and say, okay, now this account has 5,000. Okay, so the EA and the trading will be based on this 5K to trade. Okay, so it's not copy trade because the funds are tagged in. When we take trades, we are basing on just this account, one account only. So at the end of the day, let's say from here we make about, let's say a simple calculation, right? We make $500, so it's about 10% profit. Okay, so this $500 will be split back proportionately. So you can see here, this investors has more capital, right? So more of this $500 after splitting 70-30. Okay, more of this $500 will go back here. Then portion of this will go back here. Can follow that? So that's how it's done. Yes, depends on the performance of this. Yeah, so that's how PEM features work now. No. So what will happen is in PEM, we have this feature called high watermark. Okay, so high watermark means that if today you start off with 1,000, and let's say, like you say, right, it drops to 900. So after that, when it rebuilds it back from 900 back to 1,000, that $100 of profit from 900 to 1K, we will not do a profit split. The entire 100 will go back to you. Reason is because your high watermark was 1K, meaning your highest equity was 1K. So now from 1K, if it starts to build up, let's say, after splitting everything, your account grew to 1,100. Then this 1,100 becomes your new high watermark. So if it drops down to 1,000, back to your initial capital, and then we grow it back to 1,001, this $100 profit will not be split as well. You take the entire 100. Can follow, right? Because this is your high watermark. So the performance fee will only kick in if this grows beyond your high watermark. So it needs to go to maybe 1,101. Then this $1 will split. Then if this drops to 1,001 and then go back to 1,001, that $1 won't split. So the performance split will only kick in every time there's a higher equity gain. Yeah, so that's what it means by high watermark. Means the account needs to constantly grow in order to have this lot. Yeah. So that's how high watermark works. Yeah, so I think that's my last slide. Okay. Any questions related to today's topic or any of this that we share? Only FX, only dollar Canadian. Yeah, only dollar Canadian. Not complex lah. Basically, there is a martingale in it. So when the trade doesn't go in our favor, it will stack up. It will stack up. Yeah. You start to open a bigger lot size. Okay, the rough kind of management system. We look at about 50 to 70 pips for each level. So what it means is that if let's say today, rough estimation, let's say simple price point, okay, this one here we buy. Okay, now this price did not go up, so our buy trade is losing, and it drops to maybe 1.3250. Okay, so this one here, it will initiate another buy. Okay, so what will be the kind of like lot size, right? Suppose easier calculation again, if this is one lot, okay, this buy here will be somewhere around 1.70 lot. Okay, so it's not double, but it's slightly bigger. Okay, so the factor is about 0.7 something. Okay. If this keeps going, so maybe from here 1.3200 or maybe slightly lower, so it's about 50 to 70 pips range, then it will times this again times 0.7 factor, right? So you just 1.7 times 1.7. Yeah, that's the lot size. Can follow? Yeah, so that's how the management system kicks in. Okay, so it's not overly aggressive, but at times what we do is we might open two levels, two trades. Okay, meaning today here we bought in, price didn't really move much, then the EA identified, okay, we still have a good chunk of buying, right? So maybe the price was fluctuating around maybe 1.3315, 15 pips around here. We may execute another buy at one lot, base lot. This is the base lot. Okay, so then we will have two trades that's running, and if let's say it keeps going down, and these two trades will be managed accordingly. Yeah, that's how it's done. Yeah, so is the EA will look at it as a set by set. So this is one set. So this set is triggered here, right? So if this keeps going, this entire line of trades are this set. So all this would have a same TP, and we are looking to get out at net profitable. Yeah. Then this, let's say this is a second level, this is a second trade. So it can be this one TP already, but this one not yet lah. Depending on how the price moves. Yeah. One 136. Oh no. No. That this one here is factor of 0.7. The 113 is because we started with 0.01 lot. So the smallest lot size, you times this, right? It will end up also 0.01. You see that, right? Because cannot go one something. So if you are starting with 0.01 lot times 0 is this. So the third level will be 0.03. Because actually there's some decimal place behind. You times another 0.7, it becomes 0.03. Yeah. So if you do like one lot, in terms of math, it's easier to calculate because then the next level will be 1.7. So the factor ratio is somewhere around 0.7x. So it goes bigger by 0.7. How many layers? Historically, we went as deep as 7 layers. 6 to 7 layers. So each layer is about 50 to 70 pips. So about 6 to 7 if you just multiply by the smaller range. So sometimes it's like bigger than you only open the second layer, right? So we just calculate if based on this, it's about 300 to 400 pips wide. Yeah. Which is not as frequent in dollar CAD, but I cannot guarantee you that everything will be safe, right? Because that's the risk of trading. Yeah. Oh, this one also very difficult to say because depending on market movement. But I just share with you what happened here and here. So recent trades. In June we held total 2 batch of trades for about 3 weeks. Okay, because the market was moving and then after that it stalled for some time, then only recovered. Okay, so in June you realize that it's a little bit lower because the trades actually carried forward. So there's about 3 weeks of holding on to those trades. In July, we started again. We because once those trades carry forward, we close it. We have this window of period where we stop running to allow new investors to join in and old investors to make a decision whether they want to withdraw profit. So we always would have in a month, we'll always have a window of period where we will stop the EA, so no trades are running, and we have this funds movement. Okay, so last Tuesday we restarted, or I would say Wednesday morning, we restarted the trades, and then yesterday we closed all the trades again. So it ranges from 2 days all the way until 3 weeks. Yeah. So I can't say roughly how long because as fast as can be 2 days, as long as can be 3 weeks. Three sets sometimes also have 3 sets because sometimes it will also do sell and buy at the same time depending on how the market moves. Because when it's trying to resolve the buy and it detected that okay, the trend now seems to be down, right? It will start to initiate sell trade as well. So naturally, then what will happen is your sell trade will probably take profit, and then this one will try to resolve the buy, and then when it bounces back out, then you just only close the buy. Oh, the TP is about 50 to 70 pips or so for the first level for the first level, because after that, then it depends on the management to recover them for profit now. It's about 50 to 70 TP. Yeah. Yeah. Correct. Yeah, so the martingale will be holding on to the losses. Then if this goes down, the initial sell, your sell may have closed and profited while it's still resolving this buy. Yeah, so that's the risk. That's the risk is if dollar Canadian just decides to go all the way one way. Yeah. So I cannot guarantee you in the future, but I can tell you so far since 2021, it has been surviving well lah. That's all I can tell you. I can't guarantee you anything. 2021 to now, it's about close to 200%. So of course, the initial years are a little bit more aggressive. And then this one here, you see, is a little bit more conservative lah. So I always say, don't expect every month 8%, 6% lah. You expect every month 2-3% on average. So a year is about 20 plus. Yeah. So anything extra, bonus lah. Yeah. Yeah, that means this month no profit share. Yeah. No, I. Yeah. So then the profit share, nothing happened here. It will be calculated part under July. Yeah. So we won't allow that. That's why we have this window of period where we allow funds movement. Yeah. We try every month have one, but we can't promise when, because again, market condition. If the trades are running, we don't force close it. So what happened in May is nice. End of month, we don't have trade. We resolve everything. So around end of May to start of June, we can't open up that during end of month. But June, we carry forward until last week end, which is last Friday. Not this Friday, last Friday, right? So it's actually closer to maybe after end of first week of July. So June, we did not close. The opening period was first week of July. Yeah, so we can't say exactly when, but we try every month would have this window where we open up for people who wants to withdraw or people who wants to act. So once that window closed, you need to wait until the next window of period lah. Yeah, so your proportion will be higher long. So it's always a proportion of your total pool lah. Yes, that month will close off, and then what will happen is for everyone lah. So let's say 1,000, 1,000, 1,000, 2,000 let's say there's a profit, so all is higher than that, but your profit in is after the split, so you take 70% of whatever is done. Whether you want to withdraw the additional profits is up to you. If you don't, then your amount will be slightly bigger, and if someone withdraw, then your proportion in percentage in the funds will be a little bit bigger lah. So everything is automatic. So the next payout, you will get more of the profit because your proportion is bigger than the other. The performance fee is end of the month if there's a high water mark. Yeah. So let's say you start off 1K. In your account, you won't see a deduction. You won't like, oh, from 1,001, then deduct to 1,007. Yeah, you would straight away just see the split after the split. Yeah. So you would probably see end of month after everything split, you just see like that. If let's say there's $100 profit after split, you see this. So then your high water mark will be based on this. Yeah. If from here you withdraw the 70 out to your trading account, then you would start again your high water mark back to 1,000. Yeah. You won't see an addition and then a deduction. You just see the net. But every trades that's taken, you can see it. Yeah, you can see it. So you will know how much was traded, how much was made. Just that in your account, you won't see plus and minus. MT4, MT4. We try not to quit because if the system is running, but the idea is if you close the trade, right? So how put it? There is no lockdown period. There's no lockdown period. So the idea is if you try it out, 1 month, and then after that you feel that you don't want, you need to withdraw, then we will encourage during that window of period, okay, where we allow funds to get in and get out, you can actually withdraw from there. So you can take out everything if you want. Sorry? In progress, technically the system allows you to do it, but we would encourage not to, because you will disrupt the entire ecosystem. So we would strongly encourage investors to come in, really understand this. Yeah. So this window, we try to give it every month once. Yeah, but we can't guarantee you which specific date because depending on market movement. Sorry? Dollar cap. Yeah, so I don't close it except for maybe, okay, so what I did was before NFP, we are running in profit and then we are already dragging. So from June, we never managed to close it on NFP. Just before NFP, I decided to manually close it. So yesterday on Friday, also running some good profits. And then I also decided just to close it now. Other than that, it's auto run. No, we just run it. Okay, question? So then I'll pass the time to Dylan to share with you primarily the cover trade loss campaign. And then if you have any questions about Pam, she can also answer you specifically to the brokerage questions. Yeah. Ben讲. You say you'll be the one sharing. Yeah. Oh, okay. This minute. All right, guys, before we end the session, just want to share with you guys a bit about the cover loss promotion. Okay, so basically, I just want to let you guys know the sign up period, right, will be from the sign up period will be from the 10th of July to the 21st of July. Okay, so this period will be fixed. All right, so it's actually already started. So for those of you who are interested, can register within this period. And also the starting, it will be starting in 2 days, all right, the cover loss period. So you can start following the cover loss promotion on the 17th of July until the end of this month. All right, so I think that part is quite clear for you guys. So as mentioned by Coach, for 500 USD, your first 10 trades will be USD 8. But one thing just to share with you guys are for the 1000 USD and the first 10 trades for the 1000 USD, if you guys invested, it's not 16 USD, all right? It's actually more than that, it's 18 USD, all right? So if you guys invest 1000 USD, it'll be much, much more, all right? So for those of you who are looking to invest 1000 USD, please know that it's 18 USD instead of 16, all right? So I just show you guys an example of how it works, right? As Coach Karen mentioned, but I mentioned again. So let's say on the first trade, you make a profit. So the cover loss
won't take place. But let's say, can you guys go down? Okay. And then, okay, on the second trade also, we got profit. There's no cover loss. Third trade also, no cover loss. But let's say on the fourth trade, you guys made a loss of 12 USD, 12.45 cents. They will cover back. If let's say you invested 1,000, it will cover back for you. All right, so this will happen at the end of the month. Okay, it won't be immediately. You guys won't see it immediately. It will actually cover back towards the end of the month. So every time there's a loss within the 10 trade, it will cover. But as you can see, within the 11 and 12 trade, it will not cover already. So it's exactly the first 10 trades. All right, so not upon losses, but it's upon the 10 trades. All right, so this part, I think you guys are quite clear. I just want to know if you guys got any concern or question based on this. Are you guys good? Yeah. 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 So that part, okay. Any other question, guys? Guys? All right. So before we end the session also, I believe Dylan will be sharing. Yeah. The thing. Okay. Yeah. Oh, okay. Guys. Not sure why. All right, guys, great news for you guys. Okay, we're going to have a big event coming up. Okay, I hope that you guys can join us. It's actually on the 13th of August. It's actually a Sunday. It's a full day event starting from 10 a.m. all the way up to 6 p.m. All right, so we will be doing a multi-speaker event. Okay, great news for you guys. For those of you who haven't actually come for our big event, our CEO, our chairman and founder are actually coming down from our broker partner Zentinets. His name is Nick Cook. So this is a great opportunity for you guys to learn from him. He has many years of experience in the Forex industry. So for those of you who want to know for someone very experienced, it's coming all the way down from the UK on the day. This is a big event for us. It's going to be the biggest. It's going to be at Avante Hotel, PJ. So mark that in your calendar for that. Also, we have a very experienced speaker coming, Mr. Daniel Ang. He has decades of experience in the Forex market. We'll be talking on macroeconomics on that day. It's a really big deal. So for those of you who really want to know a bigger picture of Forex, you should come. Also, for those of you who are interested in technical analysis, we do have Mr. Christian Gren, who is actually talking a lot on technical. We'll also be sharing you some very good tips. I think we'll be giving out some ebooks as well, right, Dylan, on that day from this. Yeah. All right. Right. Okay. So that will be added on as well. So it's a very full day of learning for you guys. All right. And of course, we include food as well. We have lunch. We have a lucky draw session as well. All right. So to register for this event, right, you basically have to open up a trading account with our broker partner Zentinix. For those of you who already do, that's fine. But for those of you who haven't, please do open up an account. You don't have to fund it, but you just have to open an account and get it approved. All right, that is simple enough, fair enough for you guys. Do you guys have any question on this? All good? All right, great. So, what? Oh, sorry, I forgot to mention. So it's actually, oh, good question. We actually run on MT4 and MT5. You can use either one also. All right. So for those of you who want to know, we also have SAN account available. Sorry? You can use TradingView to analyze your trade. Yeah. Yeah. We don't support simultaneous here. I mean, yeah, we don't support simultaneous here. You can use it to analyze your trade, basically. Yeah. Restriction at withdrawal? No, we don't have anything. So usually, if you want to do withdrawal, right, let's say you want to withdraw your profit, strict with our compliance, you have to withdraw it to your local bank transfer. That means a local bank in Malaysia. So that's for the profit. No, basically it's fine. You can just withdraw anytime. We haven't had any serious case or anything like that. Yeah. Deposit and withdrawal, yeah, but it's following for example, do you have like XE currency? So it's actually correlated with that, basically. Basically, how it works is like we direct exchange rate. We don't, yeah, we don't have any like addition. Yeah, we don't have any third party doing the, it's direct. What is the exchange rate? We follow that. All right. You guys good? Any other question? Good. All right. Dylan? Huh? Oh yeah, sorry, I forgot to mention to guys. This event is actually limited to 100 seats. Okay, in Avante Hotel. So for those of you interested, please do get yourself registered. For those of you who haven't had an account, you can see me. I can help you guys to get an account registered. All right. All right, great. All right, guys. So with that, we want to end the session today. But in case you guys got any concern or any question, don't worry, we'll be outside after this. You guys can still ask us. But nonetheless, guys, thank you so much for coming. We hope you learn a lot. Look forward to seeing you guys next time. Thank you so much. Oh yeah, by the way, there's still food outside. Please go ahead and grab some. All right, guys. Thank you so much.